The objective of the strategy is to produce long-term excess return through stock selection, investing in international equities that are materially discounted relative to their peer group and selling them when they are fairly valued. Companies in our portfolio typically have common characteristics such as cheap equity to assets, cash flow, and earnings, and typically create solid cash flow and have a conservative balance sheet structure. We're very pleased to be celebrating our 15th year in April of this year. The team has been together, very importantly, for an average of about 13 years. The strategy began construction in 1996 when I began working on the strategy, and then we funded the strategy in 1998. Our team, through the progression that we've been together, Dan Bagdasarian, who's one of our analysts, has been with me since inception, having joined me in early 1998. Today, he covers global cyclicals. Ed Maricini joined the team in 1999. He currently covers metals and mining as well as technology. Peggy McKay joined us in 2000. She covers global services and is really our in-house Asian equity expert. Eldine Doyle joined us in 2003, covers healthcare as well as the regulated utilities. And finally, our most junior member, Bill Fitzpatrick, joined us in 2004 and has responsibility for financials, which is a lot of fun, as well as energy. We have a very defined investment process that begins by breaking the equity markets into 20 economic sectors. We use valuation screens that rank companies from most attractive to least attractive from a valuation perspective, sector by sector, country by country, region by region. What that gives us is the ability to see a very granular view of how companies are valued on a global basis. We then run them through a secondary screening process where we are looking at cash flow creation as well as balance sheet structure. All things being equal, we'd like to see very strong cash flow, and we do not like a lot of leverage on corporate balance sheets. From that, we take around 200 or so securities that fit our ideal characteristics and do our qualitative due diligence. From a qualitative perspective, we are focused really on three things. One, what are the current fundamentals of the business and where has it been recently? As you know, no equity is cheap without a reason. So what are the things that have caused the equity to underperform in the current market? And then what are the risks that we take as shareholders, and what are the opportunities that we see into the future? We're very much dependent upon equity re-rating, seeing an improvement in multiple in earnings and cash flow. So we need to make certain that the opportunities we see going forward are better than certainly better than the risks that we are taking as potential shareholders. We look to sell an equity when that valuation discount disappears in the market. So typically fourth decile valuation, we're replacing it with a cheaper name. And we'll also sell if there is deteriorating fundamentals. Clearly, something's changed, we'll move out. If a change in catalyst or opportunity perhaps may make us rethink a position, we will also trade out. Importantly, our turnover rate in the strategy is fairly low, about 20 to 25% a year. So, we take a very long-term view when we make investment decisions. We are very pleased with our long-term track record. On a 1, 3, 5, 7, 10, and 15-year basis. The strategy ranks in the top two quartiles, so we're very pleased with that. Importantly, looking at our performance, the last 5 years have been very, very challenging with markets up and down, particularly in the financial crisis of 2008. And being a value investor, we were right in the eye of that storm. We were very pleased in the end with how the strategy did manage the downside risks in 2008 without really giving up the upside opportunities that came back strongly in 2009 and 10. So I think it positioned the strategy well long term. And looking at our information ratio over the past 15 years, our information ratio is a 0.61, which puts us in the top 3% of our EFI value category, which we're very, very pleased with. Again, very much with an eye toward risk reduction, making certain that we protect to the downside as well as trying to capture as much of the upside as we can. We remain underweight Europe. We've been underweight Europe now going about 2 years. We began to underweight our European equity positions in early 2011 as we became very concerned about the developing European crisis and felt that it was being underestimated by investors generally speaking. So we have been underweighted Europe during this entire time, and we maintain that position today, primarily because we see continued earnings risks, continued uncertainty in the European markets, and frankly the equity market just is not cheap enough, in our opinion, to justify the risks that are currently there. So, I mean, there are world-class companies that we can own in Europe. We own, many businesses there that I'm very happy to own. But generally speaking, the European markets remain more challenging, and we think that there are better opportunities elsewhere. And really, how we've shifted our structure over the last couple of years is we are more overweight Asia-Pacific, ex-Japan, where we think that there is a really good combination of both, value as well as stability in terms of revenue and earnings. And we think that that's just a much more attractive longer-term place for us to be at this point in time. And so as long as those valuations remain attractive to us, most likely that tilt will stay in place. The Japanese market, of course, has been a fascinating market over the last 6 months. There's been some exceptional changes that are taking place in Japan. Frankly, we were somewhat skeptical of a lot of what is happening there. However, as we have seen in the last several weeks, that there is a serious attempt on behalf of the government and the Bank of Japan in terms of quantitative easing on the monetary side and fiscal policy to hopefully generate some inflation in the economy that might bring about some better growth longer term. So we've warmed up to Japan, and we've been moving toward going from really a neutral position to more of an overweight position in Japan, but something that we're following very, very closely. But all that aside, again, we're not ones to make really large bets against our benchmark in terms of structure, both from a country perspective and a sector perspective. So we're really very much more focused on the stock specifics to drive our decision making. But clearly we want to make sure that we're paying attention to interesting opportunities that the market gives us.